Hey everyone, today we are going to talk about two interesting companies that are quietly making big moves in their respective industries. The first one is a century old chemical maker which just posted a 49% jump in revenue and a 466% surge in profit, driven by strong commodity chemical sales despite a plant shutdown. And the second company is a jewelry exporter with just bagged fresh rupees 40 crore lab ground diamond orders, taking its order book to rupees 220 crore while expanding its premium retail brand Origami. Both are scaling up, one through high value chemicals and new geographies, the other through design-led high margin global jewelry plays. Welcome to another episode of Noisemaker, where we keep things simple and talk about companies that may not always be in the spotlight but have strong potential in the future. I am Nishant, Equity Research Analyst at Desvelado Advisory, and today we are going to talk about two companies that are making solid progress in their business, and if current trends continue, they might keep growing even further. But before we begin, here is a quick disclaimer for you. Any discussion, facts or writing provided here are for informational purposes only and do not constitute any buy or sell recommendation. Please conduct your own due diligence before making any investment decisions. So let's start with the first company, DMCC Speciality Chemicals Ltd, which manufactures and sells both commodity and specialty chemicals. Basically, the company has posted its Q1 result. They posted rupees 127 crore revenue, which is up 48.9% year on year and 1.4% quarter on quarter, despite a 20-day plant shutdown, driven by higher volumes and better realizations in commodity chemicals. On the other hand, talking about the EBITDA rose 90.6% year on year to rupees 17.2 crore, with margins improving by approximately 300 basis points, thanks to better operating efficiency. Talking about the profit after tax, it came in at rupees 7.7 crore, up over 466% year on year, supported by lower interest costs and tighter expense control. Talking about the capacity utilization in bulk chemicals, which is near peak, while specialty chemicals have room to double output without heavy capex. They are also expanding their specialty portfolio through R&D, entering Latin America and China, and improving asset efficiency. So from here, Mudit will be joining for more. So Mudit, given these operating gains and new market entries, do you think their specialty focus can offset risks from weaker Europe demand and cut price pressures?
That's a good question, Nishant. I think it's possible, yes. The domestic demand stability gives them a buffer, and specialty chemicals typically carry better margins and lower volatility compared to bulk products. Looking at FY25, revenue grew 31.5% year on year to 431.2 crores from 327.9 crores in FY24. EBITDA improved to 58.2 crores from 46.3 crores, though margins eased slightly to 13.5% from 14.1%. Net profit almost doubled to 21.5 crores versus 11.5 crores, with net margin at 5%, showing stronger profitability even with the software Q1 FY26 start. So Nishant, with margins holding steady, do you think their capex and R&D pipeline can push them into a high margin phase?
Yeah, I believe so, Mudit. Their plan is to launch several niche specialty chemicals with target operating margins above 30% and short payback periods. Three products are expected to hit full market acceptance in FY26, with more in FY27. They have also earmarked rupees 10 to 15 crore capex for FY26 to optimize existing multi-purpose plants and shift mature products to dedicated facilities. More importantly, they are not expanding bulk chemicals. The focus is shifting fully to high value specialty products for improved profitability and competitiveness. So, Mudit, if they execute this pivot well, could DMCC become a strong mid-cap specialty play in the next few years? What do you think?
Well, Nishant, that's certainly on the card. Specialty chemicals are where the margin expansion lies, and DMCC's approach, focusing on niche, high return products while avoiding low margin bulk expansions, is strategically sound. The financial discipline, market diversification, and targeted R&D make the growth path clear. To sum up, DMCC Specialty Chemicals is growing revenue and profit at a strong double-digit pace, nearing peak utilization in bulk, but doubling potentials in specialty without big capex. And the third is targeting more than 30% margins in the new specialty products with quick payback. Focus and fourth one, the focus capex and market expansion aimed at long-term profitability. If they maintain execution discipline, they could steadily transform into a high-margin specialty chemicals leader.
Yeah, totally agree with you, Mudit. So and let's now talk about our second company that we are covering today, Goldiam International Ltd, which manufactures and exports gold and diamond jewelry to global retailers. Recently, the company has secured rupees 40 crore export orders, about 5% of FY25 revenue from customers in the Middle East, Israel, and USA for lab-ground diamond stud gold jewelry. These are scheduled for completion by 30th October 2025, taking their total order book to roughly around 220 crore. The recent US tariff hike impact was contained via pre-shipment, partial cost pass-through, and tight cost management. Management expects EBITDA margins in the 18 to 22% range, with a short-term dip of 2 to 35 basis points before recovering by Q3. They also see gross margins improving as the high margin Origem, ORIGEM, which we say Origem, retail business expense planning to grow store count from 6 to approximately 25 in FY26 without extra funding, while aiming to double core B2B revenue in the next 3 to 4 years. So my question to Mudit, my question is that Mudit, with this combination of strong export orders and retail expansion, do you think Goldiam can sustain both margin and revenue growth in the near term?
It's looking promising, Nishant. Tell you what, timely execution of these orders should keep their export capacity fully utilized and strengthen relationship with overseas buyers, especially in the growing lab-grown jewelry segment. Looking at FY25, the revenue jumped 29.8% year-on-year to 800.6 crores from 616.7 crores, with the Q3 FY25 showing 104.1% sequential surge to 288 crores. EBITDA climbed to 179.2 crores from 128.2 crores, with margins up 22.4% from 20.8%. The net profit rose to 117.1 crores versus 90.9 crores in FY24, with net margins holding steady at 14.6%. So Nishant, tell me this. Given these financials, do you think their geographical diversification can meaningfully reduce the dependence on the US market?
I think it can, Mudit. While the US remains their largest revenue contributor, Goldiam is steadily building presence in Australia and the Middle East and exploring potential from the India UK free trade agreement, which we saw recently. Australia is still a low single digit share of sales, but these markets give them new growth avenues and reduce reliance on the US. On the product front, if we talk, they are adding more high carat lab ground diamond jewelry and broadening their design range, boosting average realizations per piece and maintaining pricing power. So Mudit, my question to you is that with a stronger product mix and premium pricing strategy, do you think we could see another leg of margin expansion in the next couple of years?
That's a good question, Nishant. Yes, that's quite likely. The combination of retail expansion, the premium product mix, and market diversification should support both top line growth and margin expansion. Their approach of targeting higher average realizations rather than just pushing volumes is strategically smart for sustaining profitability. To sum up, the Goldium International is strengthening its book order with high margin lab grown jewelry exports, is expanding Origam retail stores without extra funding, doubling down on core B2B growth ambitions, diversifying beyond the US into Australia and Middle East and potentially the UK. And what they are actually focusing on is like their positioning for long-term margin expansion via premium products and pricing power. If execution remains strong, they're well placed to deliver steady, profitable growth in the coming years.
Thanks a lot, Mudit. That really helped us understand the direction both these companies are moving in. Alright, now let's take a quick look at how some of previous weeks have performed. Yatharth Hospital and Trauma Care Services Limited, which picked it at 630.1, is currently trading at rupees 715, giving a return of 13.5%. Quality Power Electrical Equipment Limited Covered at rupees 720.8, is currently trading at rupees 777, giving a return of 7.8%. KDDL Limited, it moved from 2,773 to 2585.4, delivering a negative return of 6.8%. Car Trade Tech Limited, we picked this at rupees 1698.6 and is now at rupees 2164.1, giving a return of 27.4%. And the last company, GM Folder Limited, this one saw a slight rise from 1271.4 to 1280, which is a 0.7% rise. So overall, a pretty good mix of gains, and we will continue to monitor all these companies closely to see how they shape up in the coming quarters. So for your reference purpose, you can scan the QR that you are seeing on your screen to get all the companies that we have covered in our Noisemaker segment, to get all the return that we have generated in our Noisemaker segment. So you can just check it out. Now let's see the summary of today's recent filing, which include DMCC Speciality Chemicals Limited. The company basically reported a stable Q1 FY26 performance with consolidated revenue of 127 crore, up 48.9% year-on and 1.4% quarter-on-quarter. Goldiam International Limited, the company has announced fresh exports order worth rupees 40 crore, about 5% of FY25 revenue from clients in the Middle East, Israel and USA for lab-ground diamond stud gold jewelry to be completed by 30th October 2025. With this, the total order book of the company now stands at around 220 crore. So that's it for today's edition of Noisemaker. If you found this breakdown informative, you can scan the QR that you are seeing on your screen to read the full report. We will be back soon with more simple and clear market updates. Until then, stay curious, stay informed, and stay ahead.